Financial live show here today with Octaya Kavak, the director of comms and strategy at Themes ETFs, also leverage shares. You've got a whole lot going on in your side of the world, and there is a very interesting market happening right now. And I know that we are going to talk a little bit about gold and silver, touching those here, which continue to move to the upside. There's also some tariff talk that happened with Canada over the weekend that seems to be putting some waves into the market, but it's really interesting opening to the market this year. You're green on SPY and QQQ, I believe, still, but you're very green in that small cap world, and you're actually not seeing most of the green coming from Mag 7. I believe 5 out of 7 Mag 7 are red right now this year. So, initial thoughts, we just had the WEF forum. We've had a couple different other things happening. What are you thinking about this market and how we're seeing it react right now?
So I think is that we really shouldn't pay much attention to what's happened until now, at least since the beginning of Jan, just because this is the exact period that we need to really pay attention to. I mean, we're getting the Mag 7 earnings getting kicked off this week. We've got an FOMC meeting. And actually, just looking at the market today, I'm actually seeing a lot more volatility, at least, movements to the upside from the Mag 7 names that you usually see before some of them report. But I think that's going to be the real litmus test. So, do they keep continuing to beat on earnings? And do they keep showing that strength that we've been accustomed to seeing? Because although we saw a pretty broad strength in terms of the S&P's performance last year, I think this year, people are going to pay even more attention to the Mag 7. But if you look outside of those key tech names, I think there's an even bigger story brewing within the precious metal space. But maybe that's another topic that we'll get to later on.
I'm intrigued. I'm intrigued. All right. Well, one thing which I think people might end up being interested in this year, especially with all the volatility, is this concept of income investing, which really came into its own over the last 2 years. But I think this is an environment where it potentially could thrive, right? A lot of these income investing approaches really do well when you have a period in the stock market where things aren't going crazy up, aren't going crazy down, but there's plenty of volatility to make money off of. And so I wanted to get a little bit into the depths of this because I think that there's a huge movement here of people wanting to master their personal finances, right?
Yep.
And really take those to the next level and have a deep understanding of what they're investing in and how they can create consistent income and how the stock market can almost be that side hustle for them. And that's where a lot of these income investing opportunities have come from. So, can you talk to what you've seen in the rise of retail investors interested in this, maybe some of the popular names and ideologies that brought them in, but the opportunities that are opening up to them now?
I think one of the biggest investor shifts that we've seen over the last few years is, not just that retail has become more sophisticated in terms of how they approach this, how they approach their overall portfolio construction and the way they see it, but also this different ideology when it comes to certain things, like different movements, especially when you talk about FIRE. So for those that might not be familiar, FIRE stands for Financial Independence Retire Early. So it's basically like a bunch of subreddits, if you go on there, where you have millions following this concept of, if you're able to replace your day job with some kind of income stream, you don't have to be, so stressed out when you're thinking about work, when you're thinking about that long work week. So I think at its core, when you think about FIRE, it's fundamentally about control, right? Because you want more of your time back. You want to, put your stress levels a lot lower than where they probably are. And you probably want some optionality in terms of not just being dependent on that income from your job. So when people grow accustomed to getting these regular income streams, whether it's weekly, like you have in the US from some ETFs, or monthly as we have them in Europe, it almost feels like a salary replacement. And it's just something that, clicks. And I almost feel like it enables another part of people's brains where they have this aha moment where they say, okay, maybe my job isn't the only kind of income that I can, get accustomed to on a regular basis. Maybe there are alternatives out there. And we've seen this movement grow at an absolutely, you know, blazing speed over the last few years, and especially in Europe, where this is just, picking up pace over the last year and a half, I would say.
I want to dive into Europe versus the US and also maybe some of the specific tickers that we're referencing here, especially on the European side. Before doing so, as we go further into this, for the investors that are watching, this is a really interesting area of the market, but you need to carefully consider, right? Each fund's investment objectives, risk, charges, expenses prior to investing. So, all of that information, which is inside the prospectus and the summary prospectus, can be found on the company's website. So, you can go to the leverage shares, you can go to themes, ETFs, and check it out right on the websites. And I just advise investors to carefully read these prior to investing. We're very excited to be working together with your firm and to providing as much as information as possible to people as they're researching this. So break down for me a little bit, why is this so popular in Europe right now? And do you think that swing, we've already seen it in the US, people getting more into income investing, doing their research there. Do you think it's going to increase there? And then what are some of the products that you think, maybe if you want to drop specific names or pulling people deeper into this? I know that you have gold and silver products right now, but many others as well.
So if we just take a step back and just think about the global ETF space overall, what we tend to see usually is whatever happens in the US tends to sort of play out in Europe just with the 3 to 4 year lag. So if you just look at the size of the US, ETF space, we're looking at about a $13 trillion space, whereas in Europe it's closer to three. But if you look at the options income space, so these include, categories of products that include covered calls, cash secured puts, whatever. That space in the US is currently at about 170 billion. And if you compare that to Europe, the gap is massive because the market here is only 5% of what it is in the US. I think it's even smaller than that. So there's a lot of room for growth. And what we've seen over the past few years is a lot of people reaching out to us and actually, asking us whether we can bring similar structures that exist in the US here into Europe. And given that we're best known for being able to launch a lot of products around a lot of different strategies, and most of them being relatively complex, we thought this is right up our valley. So we thought, why don't we give it a go and sort of introduce this new category within the European ETF space? So we started out with a bunch of single stocks like Tesla, Nvidia, but over time, obviously, we wanted to broaden out the range, and we added a few index products like ones on the S&P and Nasdaq. We added a fixed income product, and we have a few precious metals products as well. So I think if you look at the issuers here in Europe who offer these kinds of strategies, for sure we have the widest offering just in terms of the number of products. And it's really interesting to see that among the products that we launched, the ones that have been the most popular have been, especially as of late, like the ones around precious metals. So the biggest product we have right now is GLDI, which is our Gold Plus Yield product, which basically runs a covered call strategy on top of GLD. So what you essentially get is this, monthly income of about, could be, let's say, anywhere between 1 and 2% on a monthly basis, which annualized, tends to come out to maybe, let's say, 12, maybe all the way up to 20%. And you're getting that income on a monthly basis, plus you're getting exposure to the underlying asset, which in this case is gold. And one of the more interesting products that we have apart from those, in my view, is something around treasuries. But
Mhm.
maybe that's another category that we might touch on. But just in terms of popularity, what I can say is for sure, like gold has been the most topical product, followed by probably the Mag 7 product that we have. And silver, of course, been up there as well.
Okay, so people probably have a little bit of questions here because right now gold's been screeching to the upside. We hit
Yeah.
5,100 yesterday. Right now, I'll take a look. Spot gold price at the moment, 5,091, looking pretty
Mm.
solid right now. And so when people are having these strategies that are run, which has, an option overlay, and maybe you could talk through how that works around calls, puts, vice versa. How much of that upside can they still capture, right? Are they being limited at all? Why are these products so popular right now? Is it because people think maybe there's going to be a downside at some point and they want to have some security to that? Why do you think people are being attracted in this raging bull market of metals to these products?
So if you haven't heard this phrase yet, one of the phrases that you have to become accustomed to in finance is there is no such thing as a free lunch. So you really can't have it all. This complex strategy within something that's very easy to trade. And what do I mean by that? Whenever you're, selling options, you're basically selling some of the upside capture that you might get. So obviously you're collecting some premiums in return for that. But what that ultimately means is if you have certain scenarios where the underlying might pump something like 5% in a single day, or maybe 25% over the course of the week, there's a pretty good chance that these products will not be able to participate in the full upside. Just because when you sell options, you're doing exactly that. You're selling optionality. So the person paying those premiums and buying that optionality is able to take advantage of it because they're paying those premiums. So in exchange, what you're still getting is exposure to whatever the underlying instrument is, but on top of that, you're getting that regular cash flow as well. So there's a few things to also keep in mind. If the market were to really shoot up and grow and go up aggressively, there's a really good chance that these type of products will underperform because your upside is at least to an extent capped. If the market is going sideways, there's a pretty good chance these products will outperform because rather than just staying flat, every single month you're collecting some premiums from those options sold. And over time, that accumulates to a total return that might even beat out the underlying. And if the market is going down, then all of those options that you're collecting over time means you're getting a little bit of a cushion. So you will still expect some slight outperformance compared to the underlying. So the way that you can run these strategies, obviously there's probably tens of different ways that you can do it, but the most popular one is what's known as a covered call. So a covered call is basically you own the stock, let's say it's at $100 and you want to sell call options on that stock at a certain strike price above the current price. So if the price right now is 100, you want to sell at 105, so that's the strike price, meaning you're able to capture the price movement from 100 to 105, but anything beyond that in the traditional sense of a covered call, you're basically giving up. But in return, you're getting that recurring those premiums you're collecting, which means that you are getting that monthly distribution in the meantime. One other way they can do it is in the form of put writing. So instead of selling call options, you can sell put options. So actually on our own products, this is what we're doing. We're not selling calls on all of the products, just on the more less volatile ones, I should say. So if you look at names like gold, silver, TLT, those are the ones where we have a covered call strategy. All the other ones, like the single stock names, we do what are called cash secured puts. So when you think about a put option, especially if it's in the money, it's basically two sides of the same coin. So it's almost the economic equivalent of selling an out of the money call option. So what happens is not only are you collecting premiums, you're still able to participate in, let's say, the first few percentages of the upside, but we also have a portion of the portfolio that's fully uncapped. So let's say even if an underlying like Nvidia or Coinbase were to shoot up 20, 25% in a single day, a portion of that portfolio will capture the full upside. Once again, if Coinbase does 25% in a single day, you're probably not going to get 25% in this product, but you will be able to capture a sizable portion of that. And I don't know if you want to get into it, but there are some quirks when you're running a put selling strategy versus when you sell calls that in certain market environments tend to play out slightly differently.
Interesting. So in a market like this, which, a couple of
Yeah.
years has just moved to the upside, which one do you tend to lean towards?
So what I would say is that if you have a bullish bias and you're selling in the money puts, that tends to do better if the stock market ticks higher on a regular basis. So let me just give you an example. If I were to do a covered call, right? So I'm selling a call option. It's the strike price is 105, and the underlying stock moves up, right? So let's say if the underlying stock was at 100, all of a sudden it moved up to 108, and that call that I sold, which was out of the money, all of a sudden has become in the money, meaning it's become more expensive. So if I, as the fund issuer, wanted to buy back that call that I sold, I would have to pay a really high price. So that would be a negative for the fund in terms of just additional expenses that you're incurring. So if you were to flip that scenario, let's consider an in the money put right strategy. So the stock price is still 100, and this time I'm selling an in the money put, which means an in the money put means it's above the current strike price. So that would be at 105. So what you're selling is a put option that's very expensive. And as the stock price moves up, so let's say if it moves up past the strike price, then all of a sudden it moves from in the money to out of the money. So that put option becomes quite cheap. So as the fund issuer or the portfolio manager, I should say, what I can do is I can close out that initial options position that I sold for a much cheaper price, and then I can sell another put option that's deeper in the money, and then reopen a new position. So basically, if you keep rolling and the market keeps moving up, that constant sort of weekly rolls, or it could be even more frequent in our scenario, basically means you're able to redeploy, and you're collecting premiums along the way, and you can react to the market going up much faster, and it's actually working in your favor because every time it goes up, the expensive option that you sold is cheaper. You can buy it back cheaper and sell another expensive one once again. So that's one of the scenarios where a cash secured put strategy works, a lot better in my view compared to a covered call. And we've actually seen that, right? So if you were to look at some of the performance figures, I don't want to, name any names out there, but I think especially on certain underlying names like maybe Tesla, maybe on some other underlying stocks, I think our product might be not just better
Mm.
in terms of performance compared to U.S. peers, but it might be among the best worldwide. So that's just something interesting that I noticed.
Yeah, it's super interesting, and I think it makes sense to people because a lot of people who have played around with options, specifically, buying calls and puts, have often felt the pain of that, and it's
Yeah,
typically because the other side of that trade usually wins that trade, right? And that's where it happens. It's being if you're gonna deal with options, being a seller is often more profitable,
yeah,
or at least more predictable. And I just think a lot of people, it's just the structure of doing that. So you guys have a team internally, right, that's going through and doing this on a daily basis now. And they're the ones that are actually looking at all the things that matter that go into this, right? The Greeks, states, all those different pieces, right? To ensure that people are actually
of course.
maximizing the dollars.
Of course, of course. I mean, this isn't something that you can scale, without a proper team and infrastructure in place. So, for those not familiar, leverage shares has been around since 2017, and we're
Mm,
best known for what are called leveraged ATPs, and these are mainly around individual stocks. And a lot, or I should say, all of the trading that happens in the back end where we have this daily rebalancing is done all internally. And what I mean by that is, it's done by our team of traders. So they've built this massive infrastructure that allows us to trade tens and hundreds of millions of dollars of individual stocks and ETFs on a daily basis because we have, close to 200 products that trade on 5 different exchanges. So you
mm,
really have to have that team and those operations in place to be able to scale a business like this. So this is something that they follow obviously very closely. All the different Greeks, whatever's happening in the options market. And it's one of those things where you really have to be careful before you launch the product because let's say you were to do one on an underlying where the liquidity isn't great. So
right.
all of a sudden you're trading these options on an active basis. And if you're paying like a widespread each time, that's going to be reflected in the performance of the fund, and that's when you'll see like a massive discrepancy between what's expected and what actually happens. So our approach is definitely active in terms of we don't want to just follow a passive index that's been created because as we know the market continues to evolve and you always have to evolve along with it. So it's active but it's very much rules based. So we have certain procedures in place which basically means we're able to take out that element of emotion or discretionary trading that I think some fund managers might make in terms of some mistakes.
Yeah, I think you definitely have to have a strong system built, and that's a good outline of it and a good explanation as well of the sides of hey, you can create income in multiple ways. There's a call side, there's a put side. Not all firms do both, but your firm is approaching both depending on what the scenario is. One of the names, which I know we meant,
Yeah,
to kind of talk about here today, and I know a lot of our audience is US investors, and so there's some crossover here between US and Europe, but
yeah,
TLT and TLTY, right? And
yeah,
so just explaining like a lot of people that are in my audience are very familiar with TLT. It's actually done pretty decent this year. It's up a little bit over 1% in the US market, but this has been pretty flat over the last year or so. But people are looking at this, right? This is based on bonds and some of those pieces. And a popular product over in Europe has become TLTY. Curious if you can
yeah.
kind of explain, why you think that's gained popularity and why this crowd that enjoys personal finance and creating their own income has been attracted to it.
I tend to view some products, including TLT, as some core holding positions in a traditional portfolio. But one of the downsides of such products is that they tend to
Yeah.
have these very long periods where they don't do much. And in the case of TLT, it's actually gone down and it's been dead money for a really long time. So what is TLT? You're basically getting treasury exposure. And with our approach to it, because we have TLT as underlying and we're selling calls on it, you're getting a call overwrite. So it's basically this income and like a rates exposure all in one sleeve. But
Mm,
what people forget about TLT is that it's not just a function of are rates going to go down, right? Because usually rates go down, prices of bonds go up. That means TLT should go up in theory. That's what most people think. But the reality is that TLT actually moves based on rate expectation changes rather than changes in rates themselves. So if something unexpected happens, which I really believe that this year there's a lot of surprises that we might be in for, then this might be a really interesting play. So, if those, let's say, bigger spikes in terms of volatility tend to happen, or even if they don't happen, volatility tends to spike, which means we're collecting fatter premiums, and those are going to be paid out in terms of higher distributions. But if you do look at the marketing in this from the sense of, rates might be going down maybe a little bit faster than a lot of people initially anticipated, just because we might have a new nominee for a more dovish Fed chair coming up later in May.
Right.
Just this week, we have an FOMC meeting. So obviously, that's going to have a pretty big impact if we get some surprises from there. So all of this, all of these upcoming events, including the transition from Powell to the next Fed chair, there's just a lot of things that can, I feel like, that can trigger a surprise within the Treasury markets that could make this product a particularly interesting one. And let's say nothing ends up happening, right? So let's say TLT is just as boring as ever, doesn't really move in any direction. In the meantime, you're still collecting a monthly distribution. So, from that sense, I think like I feel like it's one of the main reasons why it's getting a lot of appeal this year, which was probably not expected, at least from our viewpoint compared to our other products.
Yeah, I mean, it's basically perfectly stable over the past year, so I see exactly why it
Mhm.
makes a good candidate for something to be able to collect premium on, right? As it
Yeah,
continues to move sideways, just utilize it there. What is
absolutely.
the total return past year on TLTY?
That is a very good question. I should check that.
Yeah, and while you're looking that up, for those that are in the audience that are watching, we're talking here with the director of comms and strategy for leverage shares, themes ETFs, about income investing and personal finance. And so, if you do have any questions about how this works, we're trying to give a good explanation of the call selling, put selling, those different pieces, some of the stocks that people have gravitated towards more, how these teams work on the back end, and then just how you can supplement your portfolio with additional income. You've probably seen a lot of people talk about online. It's become a very hot theme over the past couple of years. There's right ways
Yeah.
to do it. There's wrong ways to do it. But yeah, did you have a chance to look that up?
So we just launched this product because it's one of our newer products in the range at the end of June. And since launched, it's been up close to about 3% on a total return basis. And
Mhm.
if I compare that to TLT, TLT is basically flat. So
Yeah.
this is exactly what I mean. TLT, if it tends to have it tends to have these periods of, where it tends to do basically nothing. In those periods, it's almost one of the better scenarios when you have an income options product, because in the meantime, you keep selling options, keep collecting premiums, and as an investor, you're getting that distribution payout every single month. So I think it's a really unique approach to just investing in TLT otherwise.
Yeah, and I'm sure that there's more that, do you have other examples of kinda similar type stuff that's been pretty flat for a while, where you gravitate towards it as a firm saying, "Hey, this is an opportunity for us to collect premium on?"
Yeah, absolutely. I mean, that's the one thing that you can never predict, right? It's almost
Right.
a matter of trying to foresee what's going to happen in the future. You never know what the next
Hard
hot
to do.
asset is going to be. Yeah, exactly. So, I mean, if some people would have told me that, gold and silver would be more topical today than Bitcoin and Ethereum, I definitely wouldn't have believed them. But that's why, it's our job as an ETF, ETP issuer to make like the supermarket of products where people can pick and choose whatever they want to build the type of portfolio that they're looking for, that they're looking to build over time. But I think one of the more interesting products, definitely from our standpoint, has been the precious metals. So gold and silver, by far, they've been the most popular since the beginning of the year. GLDI is our biggest product. SLVY, which is our silver plus income product, has
Right.
been one of the fastest growing since we launched it about 6 months ago. And apart from that, it's been sort of hit and miss with the individual names. So obviously Tesla, Coinbase, Nvidia, those are always quite popular. But MSTR, this is one of the biggest single stock covered call products in the US that was making headlines month after month. And honestly, I thought it would be one of our flagship products, but it's currently maybe our third least popular product.
Wow.
And like I said, you never know like what's going to happen with the underlying stock. So if you can tell me which underlying instrument or which asset is going to be popular, I can tell you any kind of products linked to that will see some level of popularity. So moving forward, those vol levels have been very subdued, especially on historically volatile names like MSTR, even Coinbase to an extent. But I can tell you, if those vol levels or those IV levels start to increase, I think people are going to start returning to these products hand over fist over the next few months.
Very interesting. And then probably good to just address it because I always do get questions on it. If you want to speak to it just for a minute or two about NAV erosion and how you avoid that within your products.
Yeah, of course. So once again, NAV erosion is something that people need to pay very close attention to, but it's also something that they need to properly understand. So NAV erosion, I think the easiest way to understand it is if the market is going down traditionally with these option income products, there is no downside protection, so they tend to go down with the market. Where they really struggle is once the market recovers after that, a lot of these products, because they cap their upside, they only capture a very small portion of that rebound. So that's where this real NAV erosion comes from. So that's why if you want to really understand how the options income product is doing compared to what it's supposed to do, really look at what's called total return. So total return is basically what you see on Yahoo Finance or your brokerage app, plus all the dividends that have been paid in the meantime. So price return plus the dividends, that equals the total return. So that is the true gauge of the success of these kinds of products. So NAV erosion is definitely top of mind when we think about structuring these products. And that's why we have these uncapped equity sleeves to make sure that there's always going to be a portion of the portfolio that will be fully able to participate in the upside move, regardless of the underlying instrument.
Yeah, it definitely makes sense to me there as well. I think people have to actually go in because a lot of brokerages don't properly display it in terms of what return is actually, right? So you have to go down, sometimes scroll down the page, actually look at total return, dividends, pieces like that in order to put the whole picture together because it's typically not just what is shown on the chart. Although more
Yep.
brokerages are making changes to reflect that a little bit better from what I've seen as we continue to move forward.
Mhm.
Okay, one other side of this, just coming back for a second to the personal finance side, just from how you think about it, when I see retail investors, there's some people that are head over heels in for this income side of thing, right? Like they're
Yeah.
just like this is their whole portfolio. And there's some people that I
Mhm.
think dabble into it, right? And have taken a couple of stabs into certain
Yeah.
areas. Do you have thoughts on, no financial advice or anything, just for retail investors that are approaching this? Like, let's say somebody's watching here, maybe they've
Yeah.
heard of this stuff, they've seen it, but it's not a big part of their portfolio right now. How they should enter into it, right? If you have broad-based index exposure, uh, what is transitioning from there? How should you be doing the research into these pieces? Is it a type of strategy that you can DCA into? Just kind of like how you think about that.
So I would take a step back and just think about what those investors are particularly interested in. So if you were to just look at different categories of ETFs, right? So if you look at dividend and bond ETFs, they yield something like 4 to 6% on an annual basis. If
Right.
you're putting your money in a money market fund, you're looking at somewhere between 3 and 4%, depending on your currency and where you live. If you want to look at savings accounts, I mean, like it's not even worth mentioning, like it's so low. So this concept of cash flow is like this new category that's really taking off just because people are, first of all, they're looking for that, that financial freedom. But in the meantime, they are, they've gone through a few cycles of the market where it's not like, everything is going up the whole time.
Right.
So especially the retail investors that got into the market post COVID, post that 2020 era, what they've only seen one direction of the market, and that's up. But for those that have been through multiple cycles now where you do actually have crashes and where you should have some, let's say, dry powder, meaning some cash on the sidelines, those people really start to appreciate the merit of having cash flow, the merit of having diversification in your portfolio, and just a slightly smarter approach in terms of not just having names that are very correlated to what the general market is doing. So I think as people pay attention to what happened over the last few years, they're doing some. They're looking back at previous periods and saying, okay, what happened to the S&P in that period? What happened to the Nasdaq? What happened to Treasuries? And what they're seeing is that there are market scenarios where all of these assets that are supposed to be uncorrelated, all of a sudden when the market's going down, correlation goes to one, so they're all crashing. So they're like, okay, how can I be participate in this whole charade, but at the same time be able to get paid every single month from some of my investments? So I think it's just like, it's discovering sort of a new functionality of your entire portfolio that people haven't had access to, at least in Europe in the past. And people nowadays, I think they're becoming to appreciate it more and more. And I think as time goes on, not only is it going to be our job to sort of educate the marketplace in terms of, the fact that these products exist, tell them how they work, and things like that. We're also going to expect them to come to us and give us newer ideas
Right.
as well, right? Because I tend to think that, retail investors in some cases have a lot better ideas compared to what we might even come up with internally. And even myself at heart, I'm like a DIY, a retail investor myself too, right? So when I think about it, I'm like, what would I be interested in investing myself? And I think before this whole income share story actually came to be, that's what we were thinking about, right? Because I think back in 2024, mid 2024, we'd already launched over 100 products. We basically covered, I think, as much as you can cover within the leverage space. We were thinking, what's the next big thing in terms of like this shift in investor sentiment and what kind of products that they want to trade. And we saw this massive boom in the income ETF category in the US. And we just thought it was a matter of time before people were demanding the same here in Europe. But like I said, currently JEPI in the US is already 6, 7 times bigger than the entire options income space here in Europe. So there's a lot of ground that we have to make up. But I tend to think that over time we might have some products that might even be popular and be listed in the US rather than us sort of trying to replicate the success of the US here in Europe. So it's going to be really interesting to play out to watch play out over the next few months, years for sure. But it's a very long term game for us, and I think by the end of this year we will have multiplied our entire product range by at least a factor of two. So
Wow, awesome. I'm looking forward to that, and we'll keep, talking about them on our shows here, letting people know as these tickers come out, encourage people to go out and actually look at the pages on X. If you're on X, if you're on YouTube, there's a lot of good content around this as well, but on X, you can go, you can look at right at Themes ETFs to see a bunch of the different pieces that we're talking about here as well, and some of the different areas of the market. I think that was a lot of great content there on the income side of things and explained really well. Before we do wrap up, just back to the market real quick. Precious metals for a second. You got any thoughts on copper here?
copper is very, very, very interesting, at least from my perspective as a DIY investor, but also within this overall narrative in terms of the deficits that we have in terms of certain metals that will have to go into certain um, themes and sectors for their future success. I think silver is, we expected it, or at least I expected it to have a very positive start to the year. Nothing compared to what we're seeing now. And I personally believe that copper might be the next big metal that is going to really take off. I don't really have too many strong views on it, but I do know that it's one of the products that investors have really reached out to us quite a lot over the last, I would say, few weeks, asking about a product that can give exposure to it. So I think copper and just precious metals and other types of commodities overall, I think it's going to be very top of mind for the year. But yeah, I'm really interested to see where that's gonna go.
Yeah, I haven't seen anyone list under COPR. I don't know if anyone has that taken on the US stock market, but it'd be interesting.
I don't know about the US, but we do have a copper tracker, so it's just like one-to-one exposure in Europe, and I think that might be the ticker. I need to double check.
Nice. Perfect. Well, there you go. You got the good one. Copper is
Yeah.
moving up here as well. Uh,
What are we
let's
up today?
spot copper is at $6.
$6. Okay.
What I want to say right now, this is, I'll just actually pull this up for a second. Um, so this is copper right here for people to see today. You can see it's up almost 5%. Year to date, it is up a little bit more than that. So that's why I like it
Hmm.
because, it's up,
It hasn't
38% this
rallied.
year, and it's
Yeah.
rallied a bit, but it's nothing like, spot gold. Um, Here, one sec, or maybe I just gotta just type gold, see if that pulls it up. boy, I have to actually do the whatever it is, something gold USD here. Spot gold
Mm,
price. We're just gonna share it here. So spot gold, people can see
gold futures. Yeah.
right here. Yeah, gold is GC. I'm always just forgetting the titles. GCHG gold. You can see the differences. Gold is up 17% year to date, and it's up 83% past year. Copper has not had those types of moves. It's up 38% past year, only 5% year to date. And then, of course, people could take a look at silver if you want to have an idea of silver. That one is up, 63% year to date on SLV 277. Silver on just today alone is up 13% at the moment. So this one is a bit of a runaway
Insane.
train.
Wow. I mean, it is just unbelievable. We have a 3x silver product within the leveraged range, and it's gone from absolutely nowhere to, I think now it's our fourth biggest product. And all of this changed over
Nice.
basically the course of a month. It's up another 37% today.
What's the ticker?
What SLV3, but this trades in London, so I don't know if
Yep,
it's going to
yep,
come
yep.
up on. So over the last 1 year, 2,600%. That, but if I
Yeah,
look at the,
I can actually pull it up here on Yahoo Finance for people.
oh, okay,
So we've got SLV3 from leverage shares, and people can see year to date 182% because of its daily reset, right?
yeah, yeah,
Yeah,
exactly.
so that's why you can see it's not just a triple necessarily. Single day up 36% today, by the way.
Yeah,
37% single day, 2,500% past year. So yeah, that just went from, $15, $10 to $239.
absolutely mind-boggling.
Yeah,
I
this
mean,
one's
the
crazy.
short, yeah, I mean, the short has been like, obviously, it's lost like 99% of its value over the last year, but
How is it still
um,
around?
I mean, reverse splits. That's financial. It's not financial engineering, but it's just like an operational update. So whenever a ticker gets to below about $1, it becomes really hard for market makers to quote on exchange. But then you can just do a reverse stock split where it goes from 50 cents to, let's say, $50, but it's just cosmetic. So you just remove some shares and the existing shares have a higher price. So it's not a big issue. So you can keep it around. Like if you look at, I think, inverse 3x QQQ from, I think it's from ProShares in the US. If you look at the
Mhm.
historic price, obviously it's down like more than 99%, but they have to keep adjusting the price. So if you were to look at it from on Yahoo Finance, you'll see an initial price of like, I don't know, probably 100,000 or something.
Wow.
But that's all because of the reverse splits along the way.
Got it, got it. Did you also see, this is a bit of a side note, but Michael Burry this morning was bull posting GME. We're back.
Really?
Yeah, I don't know if you
No.
saw this,
Oh yeah,
but
yeah, yeah. I did see that. I did.
you can
So with Roaring Kitty, right? That was the.
yeah, here's Michael Burry posting about final stop, GameStop. Jig is up, and it looks like
Yeah.
a bit of the summarization here is that he owns GME, he's been buying recently, expects to be buying out soon, maybe 1x tangible book value. Ryan Cohn investing perhaps for the next
Where's
50 years or so. This
Where's
was pretty
GME at?
interesting. Yeah, I didn't read through necessarily too much of this, but GME at the moment,
Oh, it's up 8% today. Wow.
I
Okay.
can imagine with him coming out. Well, it's just from him releasing that right now. You can see it just moved 8%, but 22% year to date, and basically flat on the 5 years, which is kind of crazy.
Does it not feel like following the right exit counts is the ultimate alpha in 2026? Like it's crazy.
There's
You
definitely
just
some X counts I know that when they post about things, those things move. That is for sure.
it's just unreal. Unreal.
Oh my gosh, literally. Got me replying to him. All right, really fun stuff throughout here. Anything else that you want to shout out before we wrap this one up?
No, not really. What I would encourage people is to, for sure, get a pretty good understanding of how different types of ETFs work before you put a single dollar in, because a bad experience for you is going to be ultimately a bad experience for us and everyone involved. So make sure you understand the products. If you have any questions, you can reach out to me directly on X, by email, reach out to Income Shares, Leverage Shares, and we have a bunch of different brands in different geographies. So whatever your product you're interested in, I think the easiest way to get more information about it is by sending us an email at info@leverageshares.com. So I really encourage people to yeah, reach out, share feedback, share comments. We're always happy to get feedback from the community.
Check it out. If you're in Europe, look at that SLV3 as well. Don't blink. Might be another 1000%. Yeah, silver, by the way, yeah, silver pumping right here. I'm getting messages on the back end. Spot silver price right now. We just moved up. We just tapped 116, is
That
what I just
is
got told. So
absolutely wild.
that is a 54% month, and
Oh,
63% of it actually last 26 days. Crazy stuff. We'll be back with more. Hope everybody enjoyed this conversation on income investing, a little bit of metals talk there as well. Thank you for joining me on this pod today on this wonderful Monday. To everybody, if you're in the Northeast, stay safe in the US, blizzards. If you're down here like me in Puerto Rico, enjoy the sunshine. If you're over in Europe, enjoy the weather's more consistent there than it is here. Just some rain. All right.
yeah,
Take care,
getting a bit of
everybody.
both.
Have a great one. Thank you, Octay.
Thanks.